Have you ever wondered why 90% of traders fail within their first year? Why thousands of people start trading every single day, yet only a tiny fraction ever make consistent profits? The answer isn't what most people think. It's not about lacking intelligence, having bad strategies, or even picking the wrong markets. The real reason most traders quit before they succeed lies in something far more fundamental. Something that happens in your mind before you even place your first trade. Picture this. You open your first trading account with $1,000. You've watched YouTube videos, read some articles, maybe even bought a course. You're convinced you've cracked the code. Within minutes of your first trade, you're already calculating how much you'll make this week, this month, maybe even planning your resignation letter. Sound familiar? This exact scenario plays out millions of times every year, and it's the beginning of the end for most new traders. But here's what's fascinating. The traders who do make it, the ones who build real wealth from the markets, they start with the exact same dreams, the same hopes, the same burning desire to succeed. So what separates them from the 90% who quit? What invisible force pushes some people through the inevitable struggles while others walk away defeated? The truth is, most traders quit not because they can't learn to trade, but because they enter the game with expectations that guarantee failure. They approach trading like it's a lottery ticket instead of treating it like the serious business it actually is. And when reality hits, when the easy money doesn't materialize, when losses start piling up, they fold faster than a house of cards in a hurricane. Let me paint you a picture of what typically happens. Week 1, you're on fire. Maybe you catch a lucky break. Maybe you nail a couple of trades. Your confidence soars through the roof. You start thinking you're some kind of trading genius. You increase your position sizes, take bigger risks, maybe even start giving advice to friends and family. This is the honeymoon phase, and it's intoxicating. Then week 2 arrives like a cold slap in the face. The market doesn't care about your previous wins. Those bigger positions you took start moving against you. Suddenly, you're watching your account balance shrink faster than you ever imagined possible. Panic sets in. Your heart races every time you look at your screen. Sleep becomes elusive as you obsess over charts and worry about your next move. By week 3, you're in full desperation mode. You start revenge trading, trying to win back what you lost. You abandon any strategy you might have had and start gambling on gut feelings and hot tips. Every loss makes you more desperate, more reckless, more determined to prove you're not a failure. But the market doesn't care about your feelings, your desperation, or your need to be right. Week 4 is often the breaking point. Your account is decimated, your confidence is shattered, you feel stupid, embarrassed, maybe even ashamed. You start making excuses. The market was manipulated, your broker was against you, the strategy you learned was garbage. You tell yourself trading is just gambling anyway, that nobody really makes money consistently, and then you quit. This cycle repeats itself countless times every single day across the globe. Bright, intelligent people enter the trading world with high hopes and leave with empty accounts and broken dreams. But here's the thing that most people miss. The failure isn't really about the money they lost. It's about the expectations they brought to the table. Most new traders approach the markets with what I call the lottery mindset. They want to turn small amounts of money into life-changing wealth quickly. They see social media posts of people claiming to have made thousands in a single day and think that's the norm rather than the rare exception. They expect to be profitable immediately, to have more winning trades than losing ones, to never experience significant drawdowns. These expectations are not just unrealistic, they're toxic. They create a psychological environment where failure is almost inevitable. When you expect immediate success and encounter inevitable losses, your brain interprets this as confirmation that you're not cut out for trading. When you expect constant wins and face a string of losses, you start questioning everything about your approach. The successful traders, the ones who make it through that first brutal year and beyond, they come to the market with an entirely different set of expectations. They understand that trading is a marathon, not a sprint. They expect to lose money while they're learning. They expect to make mistakes, to have losing streaks, to face moments of doubt and frustration. More importantly, they understand that success in trading isn't measured by how much money you make in your first month or even your first year. Success is measured by your ability to survive long enough to develop real skills, to build proper habits, to create systems that work over time. They know that the real enemy isn't the market, it's their own psychology. Think about any other professional skill you might want to develop. If you wanted to become a surgeon, would you expect to perform complex operations after watching a few videos? If you wanted to become a pilot, would you think you could fly commercial jets after reading some books? Of course not. You'd expect years of training, practice, mentorship, and gradual skill development. Yet somehow, when it comes to trading, people expect to master one of the most challenging professions in the world in a matter of weeks or months. They expect to compete successfully against professionals who have decades of experience, advanced technology, and teams of analysts. They expect to consistently extract money from a game where institutions spend millions on research and technology. The reality is that trading is a skill that takes years to develop properly. The first year is typically about learning to manage risk and control emotions, not about making money. The second year is about developing consistency and refining strategies. Only after several years do most successful traders begin to see truly consistent profits. But most people never make it past the first few months because they can't handle the psychological pressure of being wrong repeatedly while money is on the line. They can't tolerate the uncertainty, the stress, the constant decision making under pressure. They came looking for easy money and found one of the most mentally demanding challenges they've ever faced. Here's what's particularly tragic about this situation. Many of the people who quit early actually have what it takes to succeed long term. They're intelligent, analytical, capable of learning complex concepts, but they quit before they give themselves a real chance to develop the skills and mindset necessary for success. The market has a way of testing everyone who enters. It will push you to your psychological limits, force you to confront your weaknesses, and challenge every assumption you have about yourself and about money. Most people fail this test not because they lack ability, but because they weren't prepared for how intense the examination would be. This brings us to a crucial point that most trading education completely ignores. Before you ever worry about chart patterns, indicators, or market analysis, you need to prepare yourself mentally for what trading actually involves. You need to understand that you're entering a profession where being wrong 50% of the time can still make you wealthy, where your biggest enemy is your own emotions, and where patience and discipline matter more than intelligence. The traders who survive and thrive are the ones who come to terms with these realities early. They accept that losses are part of the business, that learning takes time, and that success requires a completely different approach than what most people imagine. They develop what I call the professional mindset. They understand that every other business requires capital to operate, and trading is no different. A restaurant owner doesn't expect to never waste food. A retail store doesn't expect to never have unsold inventory. Yet traders often enter the market expecting to never have losing trades, which is like expecting to run a business with zero operating costs. This professional mindset shift changes everything. Instead of seeing a losing trade as a personal failure, you start seeing it as a business expense. Instead of getting emotionally attached to each position, you start thinking in terms of probabilities and long-term outcomes. Instead of trying to be right all the time, you focus on being consistently profitable over hundreds of trades. But here's where it gets really interesting. The market seems to have a built-in mechanism for weeding out people who aren't serious about treating it as a profession. It's almost as if the market deliberately creates situations designed to test your commitment and psychological strength. You'll have trades that move in your favor immediately, only to reverse just before hitting your target. You'll have perfect setups that fail spectacularly. You'll experience winning streaks that make you overconfident, followed by losing streaks that make you question everything. The market will present you with opportunities that look too good to be true, and they usually are. These aren't accidents or coincidences. This is the market's way of testing whether you have the mental fortitude to stick with a systematic approach, even when it's uncomfortable, even when it's not working in the short term, even when every instinct in your body is screaming at you to do something different. Most people interpret these tests as signs that trading doesn't work or that they're not cut out for it. They don't realize that every successful trader has faced identical challenges and had identical thoughts. The difference is that successful traders push through these moments instead of using them as reasons to quit. Let me tell you about the emotional cycle that almost every trader goes through. But before I do, drop a like down below and subscribe to the channel if you've made it this far in the video. So here it is. The cycle starts with excitement and optimism. You're convinced you found your path to financial freedom. Then comes the first real loss, and doubt creeps in. Maybe you got unlucky, you tell yourself. Maybe you made a mistake. Then comes the second loss, and the third. Now you're questioning your strategy, your education, your ability to succeed. You start looking for new approaches, new systems, new mentors. This is the searching phase, where you jump from method to method, hoping to find the magic formula that will make everything click. Next comes the frustration phase. Nothing seems to work consistently. You've tried multiple approaches and they all seem to fail when it matters most. You start blaming external factors. The market is rigged. The big institutions have unfair advantages. Retail traders can't compete. Then comes despair. You're convinced you've wasted your time and money. You feel stupid for ever thinking you could make money trading. You start telling people that trading is impossible, that it's all marketing hype designed to separate fools from their money. Finally, most people reach the quitting phase. They close their accounts, sell their trading books, and never look at a chart again. They join the ranks of the 90% who gave up before giving themselves a real chance to succeed. But here's what's fascinating about this cycle. The successful traders go through the exact same emotional journey, but they don't quit at the end. Instead, they use that experience as the foundation for real growth. They realized that their emotions were the problem all along, not the market or their strategies. This realization marks the beginning of true trading education. Everything that came before was just paying tuition to the market. Now the real learning begins. They start focusing on psychology instead of just technique. They begin developing systems for managing emotions instead of just managing trades. They learn to embrace uncertainty instead of fighting it. They accept that they'll never be able to predict what the market will do next, but they can control how they respond to whatever happens. They stop trying to be right and start trying to be consistent. This is where the separation really occurs between those who eventually succeed and those who quit. The quitters see uncertainty and unpredictability as problems to be solved. The successful traders see them as fundamental characteristics of the market that must be accepted and worked with. Most importantly, successful traders learn to measure success differently. Instead of focusing on how much money they made this week or this month, they focus on whether they followed their plan. Instead of celebrating big wins, they celebrate consistent execution. Instead of fearing losses, they respect them as part of the process. This shift in perspective is what allows them to persist through the inevitable rough patches that destroy most traders. When you're measuring success by process rather than just profits, you can have a losing month and still feel good about your progress as long as you stuck to your rules. The market rewards this kind of thinking, but it takes time. The psychological skills necessary for successful trading develop slowly, through repeated exposure to stress and uncertainty. You can't rush this process any more than you can rush building physical strength. It requires consistent practice over extended periods, but most people quit long before these skills have a chance to develop. They want the results without going through the necessary psychological conditioning. They want to skip the uncomfortable learning phase and jump straight to consistent profits. This is why so many intelligent, capable people fail at trading. It's not that they can't learn the technical aspects. Most people can understand chart patterns, indicators, and basic market mechanics relatively quickly. The challenge is developing the psychological resilience to apply that knowledge consistently under pressure. The market is constantly testing your ability to stick with your plan when it's uncomfortable to do so. It will present you with situations that trigger every psychological weakness you have. Fear, greed, impatience, overconfidence, desperation, hope, regret. The market will find ways to activate all of these emotions at precisely the worst possible moments. This is where most traders make their fatal mistake. They think these emotions are bugs in the system, problems to be eliminated. But they're not bugs, they're features. The market is designed to trigger these psychological responses because that's how it separates money from those who can't handle the pressure. Every successful trader has learned to work with their emotions rather than against them. They don't try to eliminate fear. They learn to trade despite being afraid. They don't try to suppress greed. They learn to channel it productively. They don't try to become emotionless robots. They learn to make rational decisions while experiencing intense emotions. This is a skill that can only be developed through experience. You can't learn it from books or videos. You have to live through the fear of watching a position move against you. You have to experience the temptation to overtrade after a big win. You have to feel the desperation of trying to recover from a series of losses. Most people can't tolerate this psychological boot camp long enough to develop these skills. They tap out during the training phase, convinced that the discomfort they're experiencing means they're not cut out for this business. They don't realize that discomfort is not a sign of failure. It's a sign that real learning is taking place. Think about learning to drive a car. Remember how overwhelming it felt at first? You had to consciously think about every action. Checking mirrors, signaling, monitoring speed, watching for pedestrians, maintaining proper distance from other cars. Your brain was on overload trying to process all this information simultaneously. Now you probably drive without even thinking about most of these actions. They become automatic, unconscious responses. But that only happened because you pushed through the initial discomfort and confusion. You didn't quit the first time you stalled the engine or made a mistake. Trading follows the same learning curve, but the stakes feel much higher because money is involved. Every mistake costs you real cash, which makes the learning process exponentially more stressful. This is why most people quit before reaching the unconscious competence stage, where trading becomes natural and intuitive. The successful traders understand that the money they lose while learning is not wasted. It's invested in their education. They view those early losses as tuition payments to the greatest business school in the world. They know that the psychological conditioning they're receiving is worth far more than the money they're losing. But here's what makes this even more challenging. Unlike other skills where you can practice in a safe environment, trading forces you to learn under live fire. Every decision has immediate financial consequences. Every mistake costs money you can actually lose. There's no practice mode, no simulation that truly captures the psychological pressure of having real money at risk. This creates a unique learning environment where your emotions are constantly heightened. Your fight or flight response is activated every time you place a trade. Your brain is flooded with stress hormones that make rational thinking more difficult. You're trying to learn complex skills while operating in a state of chronic psychological arousal. Most people's brains simply can't handle this level of sustained stress. They start making increasingly poor decisions as their emotional state deteriorates. They begin taking bigger risks to try to recover losses quickly. They start ignoring their own rules because following them feels too slow and uncertain. This is the point where most traders enter what I call the death spiral. Every bad decision leads to bigger losses, which creates more stress, which leads to even worse decisions. They become trapped in a cycle of increasingly desperate behavior that almost always ends in complete account destruction. The traders who survive this phase have learned to recognize when they're entering the psychological danger zone. They've developed systems for stepping away from the market when their emotional state becomes compromised. They understand that preservation of capital is more important than trying to force profits when they're not thinking clearly. This requires a level of self-awareness that most people haven't developed. You have to become intimately familiar with your own psychological patterns. You need to know what triggers your fear responses, what makes you overconfident, what situations cause you to abandon your discipline. Most people have never had to examine their relationship with money this closely. Trading forces you to confront every limiting belief, every emotional weakness, every irrational behavior pattern you have around finances. It's like having a mirror held up to your psychological soul, and most people don't like what they see. The market has a way of finding your weakest psychological point and attacking it relentlessly. If you're afraid of losing money, it will present you with situations where following your plan requires accepting losses. If you're impatient, it will force you to wait through extended periods of sideways movement. If you're overconfident, it will humble you with unexpected losses just when you think you've figured everything out. This isn't personal, it's just how markets function. They're designed to be efficient, which means they're constantly working to eliminate predictable patterns and easy profits. The moment too many people start using the same strategy, the market adapts and that strategy becomes less effective. This constant evolution is another reason why most traders quit. They expect to find a system that works forever, but no such system exists. The strategies that work today may not work next year. The patterns that were reliable last month may disappear next week. Successful trading requires constant adaptation and learning. Most people can't handle this level of uncertainty. They want guarantees, predictable outcomes, clear rules that always work. They want trading to be like following a recipe where the same ingredients always produce the same results. But markets don't work that way. The successful traders embrace this uncertainty. They understand that adaptability is more valuable than any specific strategy. They're constantly testing new approaches, refining their methods, and adjusting to changing market conditions. They see uncertainty not as a problem to be solved, but as the fundamental nature of the game they've chosen to play. This adaptive mindset is developed over years of experience, not months. It requires surviving multiple market cycles, seeing how different strategies perform in different environments, and learning to read the subtle signs that indicate when market character is shifting. But most traders never develop this long-term perspective because they're focused on immediate results. They want to know if they're going to be profitable this month, this week, maybe even today. They can't tolerate the uncertainty of not knowing whether their current approach will work over the next 100 trades. This short-term focus creates enormous psychological pressure. Every trade feels crucial because they're measuring success over such a compressed time frame. A single losing trade can feel like a catastrophic failure instead of just one data point in a much larger sample size. Professional traders think in terms of thousands of trades over multiple years. They know that any individual trade is essentially meaningless in the context of their long-term results. This perspective allows them to remain emotionally detached from short-term outcomes and focus on executing their process consistently. Developing this long-term perspective requires surviving in the market long enough to actually execute thousands of trades. Most people quit after dozens or maybe hundreds of trades, never giving themselves the opportunity to see how their approach performs over statistically significant sample sizes. This is perhaps the greatest tragedy in trading. People quit just when they're starting to develop the psychological skills necessary for long-term success. They abandon the game right when they're beginning to understand how it actually works. They give up their education just when it's starting to pay dividends. The market doesn't care about your timeline. It doesn't care that you need to make money quickly to pay bills or fund your lifestyle. It doesn't care that you've invested months or years learning to trade. It operates according to its own rhythms and cycles, and successful traders learn to synchronize with these natural patterns rather than fighting against them. This synchronization takes time to develop. You have to experience multiple market cycles. See how different strategies perform in trending versus ranging markets, and learn to recognize the subtle signs that indicate changing market character. You have to develop an intuitive feel for market rhythm that can only come through sustained exposure over extended periods. Most people quit long before developing this market intuition. They expect to understand market behavior intellectually through study and analysis, but true market understanding is more like learning a language than memorizing facts. It requires immersion, repetition, and gradual absorption of patterns that can't be easily explained or taught. The successful traders who make it through this extended learning process develop something that looks almost like magic to outside observers. They seem to have an uncanny ability to sense market direction, to know when to be aggressive and when to be defensive, to adapt their approach seamlessly to changing conditions. But this isn't magic, it's expertise. It's the result of thousands of hours of focused practice, countless mistakes, and persistent refinement of skills over years of dedicated effort. It's the same process that creates expertise in any other demanding field, but most people quit before reaching this level of mastery. The market rewards this kind of dedication, but it takes time. The psychological conditioning, the pattern recognition, the emotional control, the adaptive thinking, all of these skills develop slowly through repeated exposure to market stress and uncertainty. You can't shortcut this process any more than you can shortcut becoming a master musician or elite athlete. But most people want the results without investing the time. They want to skip the years of practice and jump straight to consistent profitability. They want the rewards of mastery without going through the necessary development process. And when they discover that this isn't possible, they quit. This is the fundamental reason why most traders fail. Not because they lack intelligence or access to information, but because they're not willing to invest the time and psychological effort necessary to develop real expertise. They approach trading like a get-rich-quick scheme instead of treating it like the serious profession it actually is. The irony is that the market actually provides clear signals about who will succeed and who won't within the first few months. It's not about your win rate or how much money you make initially. The market reveals your character through how you handle adversity, how you respond to uncertainty, and whether you can maintain discipline when everything inside you is screaming to abandon your plan. Most people fail this character test because they've never been in a situation where their psychology is under constant assault. In regular jobs, you show up, do your work, and get paid regardless of your emotional state. Your paycheck doesn't depend on your ability to make split-second decisions while managing fear and greed simultaneously. Trading strips away all the safety nets. There's no boss to blame for bad decisions. There's no steady paycheck to fall back on. There's no corporate structure to provide security and predictability. You're completely on your own, making decisions that have immediate financial consequences, with no guarantee that doing the right thing will be rewarded in the short term. This level of personal responsibility terrifies most people. They've spent their entire lives in systems where someone else makes the important decisions. Suddenly, they're thrust into an environment where every choice is theirs to make, and every mistake costs real money. The psychological weight of this responsibility crushes most new traders before they learn to handle it. What makes it even more challenging is that the market punishes hesitation just as severely as it punishes recklessness. You can't succeed by playing it safe, but you also can't succeed by being careless with risk. You have to find that narrow middle ground between fear and greed, between caution and aggression, between patience and action. This balance point is different for every trader and changes based on market conditions. What works in trending markets fails in ranging markets. What works with high volatility fails when volatility drops. You're constantly recalibrating, constantly adjusting, constantly walking a psychological tightrope with your financial future hanging in the balance. Most people can't handle this level of complexity and ambiguity. They want clear rules, obvious signals, and predictable outcomes. They want to know exactly what to do in every situation, but the market doesn't provide this kind of clarity. It's constantly evolving, constantly changing, constantly presenting new challenges that don't fit neatly into predetermined categories. So here's the brutal truth that nobody wants to admit. Most traders quit, not because they can't learn the technical skills, but because they refuse to accept what trading actually demands of them as human beings. They want the profits without the psychological transformation. They want the freedom without the responsibility. They want the rewards without paying the price in time, discipline, and emotional growth. The 10% who succeed aren't smarter, luckier, or more privileged. They're simply willing to endure what the 90% won't. They're willing to lose money while learning. They're willing to be wrong repeatedly while building their skills. They're willing to face their psychological weaknesses and do the hard work of changing themselves. If you're serious about trading, understand this. You're not just learning to read charts or manage risk. You're signing up for one of the most intense personal development programs on the planet. The market will force you to confront every weakness, every fear, every limiting belief you have about money and success. Most people quit because they think the market is the enemy. The successful traders realize that the market is actually the greatest teacher they'll ever have. It doesn't lie, it doesn't coddle, and it doesn't accept excuses. It simply reflects back the truth about your discipline, your patience, and your ability to think clearly under pressure. The choice is yours. You can join the 90% who quit when things get difficult, blaming the market for their failure. Or you can join the 10% who use every setback as fuel for growth, every loss as a lesson, and every challenge as an opportunity to become stronger. The market will be here tomorrow, and the next day, and the next. The question isn't whether trading works. The question is whether you have what it takes to stick around long enough to make it work for you.